Welcome to the ProTicker Deep Dive.
Great to be here.
We are jumping into one of the biggest paradoxes facing the financial world right now. This massive looming question mark over commercial real estate debt. And, more importantly, the regional banks that are holding it.
It really is a puzzle. I mean, the warnings are deafening, right? You see headlines every single day about empty office towers, massive vacancies.
And almost $1 trillion in loans coming due.
Exactly. And yet the official regulatory narrative seems so calm. The 2025 stress test just came out, and they declared the biggest banks, the giants, are all sufficiently capitalized. They're safe.
That's the conflict. That's what we really need to unravel for you today. Are we looking at a genuine crisis, a contagion that could spread? Or has the risk really been contained?
Has it been isolated?
Right. And our mission today is to look past those big generalized stress tests. We need to get granular and focus on the smaller regional institutions.
Because that's where the risk is.
That is where the vast majority of concentrated risk is lurking.
And, here is the essential takeaway we want you to have from this. The American banking system as a whole is robust. We are not anticipating a 2008-style collapse where everything just freezes.
Okay, so not Armageddon.
Not Armageddon. However, that regulatory assurance is deeply misleading. The real stress isn't some theoretical thing in the future. It's already here. It's hitting now, and it's focused intensely on office properties and a massive non-negotiable wall of maturing debt.
To really get a handle on this pressure cooker, we have to rewind a bit, right?
Yeah.
Just a few years to 2021, 2022. What did that lending environment even look like?
Well, it was a borrower's paradise. I mean, interest rates were at historic lows, basically zero.
Free money?
It was free money. And regional banks were extremely hungry for yield. So they just loaded up their balance sheets with commercial real estate mortgages because, they offered a nice interest spread compared to safer government bonds.
They gorged on cheap debt, as our research puts it. And that decision, which made perfect sense 3 years ago, has been completely wiped out by what you can only call a perfect storm.
It really is. And the first part of that storm is a permanent loss of demand. We're talking about remote work.
The structural shift.
It's a structural shift. The pandemic accelerated it beyond anything we've ever seen. This isn't a cyclical downturn where people come back to the office later. This is fundamental demand destruction. Buildings that were built and valued for 95% occupancy are suddenly at 70%, maybe less.
And that valuation model is just permanently broken?
It's broken, and that structural rot then collided head-on with the second factor.
The most aggressive monetary tightening in decades.
That's right. Between 2022 and 2024, the Fed hiked rates from near zero to over 5%. And that move just immediately compressed all asset valuations.
And the math on refinancing today,
Yeah.
It's just brutal. Let's say you're a building owner. You took out a loan at 4% back in 2020. It's maturing now in 2025.
You're now looking at market rates between 7 and 8% to renew that debt. That jump it's often insurmountable.
Your interest expense doubles.
It doubles, and your net operating income gets completely wiped out. You can't service the debt, especially when the property itself has plummeted in value, maybe 20, 30% in some big cities.
We're seeing vacancy in San Francisco pushing, 27.7%? New York is near 23%?
No lender wants to touch a property that's that underwater.
So let's pivot to where this risk actually lives. We know the big banks, your JP Morgans and Bank of Americas, they're doing okay. For them, CRE is a manageable slice, maybe 6% to 21% of their total loans.
But the contrast with regional banks is just stunning, and this is the core vulnerability we've been talking about. For regionals collectively, CRE debt makes up a staggering 44% of their total loans.
44%. That's more than double the large bank average.
Yeah.
For a lot of these smaller banks, commercial real estate is literally their main business.
It is their business, and that intense concentration brings us right to a regulatory red line. Regulators start getting nervous when a bank's CRE exposure goes over 300% of its total equity capital.
And the data shows at least 6 major regional banks are already past that threshold.
And it gets pretty existential when you look at the most extreme examples. Flagstar Bank leads the list.
Okay.
They have about $40 billion in CRE mortgages against only $8.6 billion in total equity.
Wait a second. 40 billion versus 8.6?
Yes.
That's a 499% ratio, almost 5 times their core equity capital.
It's devastating. You can think of it this way. They are betting $5 for every $1 of their own safety cushion.
Wow.
So if they face even a small loss on that portfolio, say 10%, their capital cushion is essentially gone. And we see others too. Zion Bancorp at 389%, Valley National at 373%, Synovus at 381%. This isn't an isolated problem.
And here's where the picture gets even darker, right? Because even those reported capital figures might be overstating how safe these banks really are.
They absolutely are. Because of the Fed's rate hikes, the market value of all those long-dated bonds that banks bought when rates were near zero, it's fallen dramatically.
If they pay a low old interest rate.
Exactly. They're worth less. Now, banks don't have to report those as losses if they plan to hold them to maturity, but those are still very real, unrecognized, mark-to-market losses.
So their true ability to absorb a shock
Is significantly lower than the comforting numbers they report to regulators. Their safety net is already frayed.
Okay, let's talk about urgency. This isn't a theoretical threat for 5 years from now. There is a strict timetable here, a ticking clock.
There is. The historical annual average for CRE debt coming due is usually around $350 billion. That's what the market can normally handle.
But the magnitude of this is about to triple. In 2025, a stunning $957 billion in CRE loans came due.
And the pressure cooker stays on. In 2026, it's nearly the same amount, about $936 billion. This is the literal debt maturity wall.
And it's concentrating all this stress into the next 18 months.
Within that wall, the office sector is ground zero. National office vacancy is at 20.7%, a record high, and it's still climbing.
And you can see the real pain in the securitized loans, right? The commercial mortgage-backed securities, the CMBS market.
That's where it's undeniable. The CMBS delinquency rate for office properties has absolutely exploded. It hit 11.76% as of October 2025.
That figure is so critical because it's already higher than the peak of the 2008 financial crisis, which was around 10.5%.
Let's just pause on that. We are talking about the commercial real estate market right now, showing delinquency rates that are functionally worse than the residential mortgage market was at the absolute peak of the 2008 crisis.
And the speed of it.
The speed is terrifying. Just 3 years ago, office CMBS delinquency was 1.8%. It's peaked over 10 percentage points in 36 months. This is a rapid structural collapse.
So with this debt wall hitting right now, what are lenders and borrowers doing to avoid just mass default?
The main tactic is something called extend and amend. It's basically a short-term Band-Aid.
Just kicking the can down the road.
That's exactly what it is. Lenders grant a temporary reprieve, maybe 12 or 24 months, by modifying the loan. It prevents an immediate default, which, helps keep the official delinquency numbers looking deceptively low.
It just makes the problem bigger later on.
Precisely. It postpones the crisis, but it amplifies future stress. These extensions usually come with a higher interest rate, tighter rules. It just squeezes the borrower's already weak cash flow even more. The reckoning is just pushed to 2026 or 2027.
And we've been focused on offices, but we shouldn't ignore other sectors. Multifamily residential, which has been performing better, has still seen delinquency rates rise to 7.1%.
And that matters. It matters a lot because regional banks are huge multifamily lenders. Flagstar, for example, has $32 billion of its $40 billion in CRE tied up in multifamily.
So this all comes back to the regulatory safety net. Why are those good stress test results so misleading?
Because they only cover 22 of the largest, most diversified banks. They completely ignore the 4,000 plus smaller community and regional institutions that are holding most of this concentrated risk.
And it's also about what they measure, isn't it? They test for a system-wide global collapse, not for localized shocks.
Right. They miss what's called idiosyncratic risk or cluster risk. The test assumes diversification. It doesn't model a scenario where, say, the entire commercial property market in Chicago just collapses, hitting every single overweighted regional bank there at the same time. The tests just miss that.
Speaking of hidden risks, let's talk about the loan books themselves. The overall reported CRE delinquency rate for commercial banks is low, about 1.55% as of mid-2025. That sounds fine.
It sounds great, but it dramatically understates the true danger. Research shows that reported delinquencies understate the risk from what are called under-collateralized loans by a factor of 4.
Okay, let's unpack that. What's an under-collateralized loan?
It's a loan where the borrower is still making their monthly payments, so on paper it's performing, but the building itself is now worth less than the debt on it.
The bank is upside down.
The bank is completely upside down. If the borrower defaults tomorrow, the bank gets back an asset worth way less than the loan on its books. These are, as the sources put it, time bombs masquerading as performing loans.
And the market already sees this, doesn't it? Regional bank stocks have been getting hammered.
Absolutely. They've consistently underperformed because smart investors are skeptical about the true asset quality buried in these portfolios. They are pricing in those time bombs right now.
So what's the outlook for the next 18 months as this maturity wall just slams into the sector?
Well, there's a range of scenarios. The best case, the bullish scenario, is that the Fed starts cutting rates aggressively in 2026
Which would stabilize property values, ease refinancing.
and allow the stress to dissipate. The bearish scenario. A recession hits at the same time as the maturity wall. Office vacancy goes past 25% nationally,
Widespread defaults.
widespread defaults, and you could see government intervention or forced consolidation of a dozen or more regional banks.
And the base case is probably somewhere in the middle.
I think so. Selective failures among the most exposed banks, your Flagstars, your Zions, and a lot of consolidation. Healthy, larger institutions will be actively acquiring troubled smaller ones at steep discounts.
So for you, as an investor, what's the takeaway?
Selectivity is everything. Systemic collapse is unlikely, but individual failure risk is high. Know the CRE concentration of any regional bank stock you own. If it's over 350%, caution is definitely warranted. Maybe trim that exposure.
But there's opportunity here, too, for value investors.
For sure. You can look for regional names trading well below their book value, especially those with diverse portfolios and manageable office exposure. If rates do start to decline, these stocks could see some outsized returns, but patience is key. The pressure is just compounding into 2026.
So the final synthesis here is pretty clear.
Yeah.
Don't be comforted by that passing grade on the stress test.
Not at all. The underlying structural pressure, the vacancy crisis, the debt wall, the extreme concentration, it's all very real. And you can see it already in that 11.76% office CMBS delinquency rate, a rate that, again, is already past the 2008 peak.
The challenge for the next 18 months is to see through that regulatory noise and understand the fundamental weakness hitting these regional players right now. So, since consolidation is the likely outcome, here's a provocative thought for you to consider. Which of the major diversified institutions are best positioned and capitalized to acquire these troubled regional competitors at steep discounts, potentially creating a massive opportunity amidst all this market stress? See you all in the next ProTicker Deep Dive.